Hey, what's up? Thanks for checking out this video. So today I'm going to share my different experiences with you that I've had when it comes to purchasing a home. I'm 37 years old, but this is the third house that I've purchased with my husband. We've never had a house to go into foreclosure. We've never had to short sell a house. A lot of times it can be very easy to get something such as a house or a car, and a lot of times the hardest part can be keeping it. So there are a lot of pitfalls that can impact you, and it's very easy to get caught up if you don't have certain information, like if you don't know exactly what you're getting into. Sometimes realtors may not tell you everything that you need to know. Sometimes your loan officers may not tell you everything that you need to know, but I'm gonna make sure that I cover a lot of what you need to know, if not all of it, in this video. So let's go ahead and jump into this. So once you've been pre-approved for an amount, I do not recommend that you start shopping for houses that are equal to that pre-approved amount. And like as an example, with our first house, we were pre-approved for $250,000. But my husband and I, we already had our minds made up that we were not going to spend over $175,000. The reason for that is because if he ever lost his job, I wanted to make sure that I could foot the bills and that I wouldn't have to struggle. And I wanted to make sure that he was able to do the same in the event that I lost my job. So in our area at that time, when we first purchased our home, we could have found nice houses for like 150, 160, 170 in great neighborhoods that had like decent schools. So there were other things that we also took into consideration too, because when you have a home, there are so many unexpected things that can happen. You know, you may have an issue where you may have to replace your hot water heater. You will have to replace your roof over a certain amount of time. You may have plumbing issues, you may have electrical issues. So there are so many things that could happen after you purchase your home. When we purchased our first house in 2006, we only had one child at that time. So a few years later, we did have another child. Well, when we had our other son, we actually had to spend over $10,000 in medical bills. So like when I say we spent, it wasn't like what insurance paid for. That was the amount that we were responsible for all of the doctor visits that we had to pay. So it's like that was something that we were not prepared for. It was not something that we were able to predict or plan for, that we would spend that much. But it's just we had to make sure that our son was able to get the medical treatment that he needed. So of course, thankfully now he's running around. You would never ever know the challenge that he had, you know, as a baby. But had we actually spent the $250 that we were pre-approved for, we could have lost our house. We wouldn't have had the extra money to pay for these medical expenses that we had to pay. So when I say that things can happen that's beyond your control, this is an exact example of that. So I'm glad that we actually went with the safe side as far as with not spending the $250 and not exceeding the $175 that we both agreed upon. So with banks, once you've been pre-approved for an amount, of course they've looked at your credit report, but just keep in mind, not everything that you spend your money on is captured with your credit report. You know, you're gonna see things like auto loans, credit cards, student loans that appear on your credit, you know, on your credit report. But as far as with like daycare bills, utility bills, medical bills, those things typically don't, they're not typically reported to the credit bureau, unless of course, you have like a judgment or something like that where you're sued for it. But of course with banks, a lot of them, they do require that you submit bank statements along with check stubs, and they just want to see how you're spending your money, where your money is going to, how much is coming into the account. But also when some people purchase homes, their debt to income ratio increases after they purchase a home. They may go out and purchase another car. They may go out and open credit card accounts. So it's just a way that you want to give yourself some cushion just in case your financial situation changes. So I look at it like, just because you were approved for a certain amount on paper does not necessarily mean that you can actually afford that amount over time. So, loan officers. We decided to go with a loan officer who is self-employed and she doesn't work for a particular bank. The reason why we decided to go this route is because, let's just say if I wanted to apply at, let's just call it Bank A, I would have had to complete an application, submit some documentation, they would have pulled my credit, and then at that point, they would have told me what my interest rate would have been if I would have gone with them. Well, let's say if I didn't like their interest rate and I wanted to shop at another bank, I would have to go through the entire process again with completing an application, and then it would be another credit pull. So the benefit for me with actually using the loan officer who did not work for a bank is that she actually pulled my credit one time, and then at that point she was able to shop at different banks on our behalf to find the best interest rate for us. And the banks that she got the rates from, they're reputable banks, they're well-known banks. So the only downside that I saw from working with someone who's self-employed, who shops around for you, is that she did not actually work with credit unions. And a lot of times, based on my experience, I found that credit unions have lower interest rates than some of these other big banks. So interest versus principal. So when you are financing a home, you want to get the lowest rate possible, because the higher your interest rate is, the higher your mortgage payment will be. The higher your interest rate is, the more interest you are going to pay every month when you make your payment. So when you make your payment, the amount that goes towards interest does not decrease your overall balance at all. The thing that gets your balance down are payments that go towards principal, where if your interest rate is too high and majority or all of your payment is going towards interest, you're never going to be able to lower your balance. So that's the importance in making sure that you get a good, low interest payment, and not an actual interest rate when you're shopping for a home. So a fixed rate versus an adjustable rate mortgage. Now, I could have gotten caught up with this, but I just went with my gut when it came to this. So with the first home, I was 20 years old when we purchased that back in 2006. And we were going to use a loan officer who was a family friend. Well, who is a family friend. He knows my entire family. I know his entire family. He knew me ever since I was like a child. So I felt like this person really had our best interest at heart. So we sat down, we talked with him, and he really tried to convince us to go the route of getting an adjustable rate mortgage. So then I asked, well, how does it work? And I can't remember the rate that he quoted us, but like as an example, he was saying that the rate would have been, let's just say 3% for 5 years. But after 5 years, your interest rate could go up to 11% or 13%. So when you're actually purchasing a home that costs like over 100,000 or 200,000 or 300,000, like an interest rate like 10% or 11% is like super high. So to try to reassure us, what he told us was that we can definitely refinance the home as long after the 5 years. He said we could either sell it or we could either refinance the home as long as we kept our jobs and as long as we kept up with our credit report. So to me, even though I was only 20, I kind of had like some kind of a financial background just from working like for a company or whatever. I just didn't have a good feeling about that. I'm like, well, you know, not everybody quits their job. What if you're laid off? That's something that's, you know, beyond your control. What if it takes you some time to find another job? Or what if you can't find a job making the amount that you were making at your previous job? I'm like, just to go with this low rate for 5 years, I just didn't have a good feeling about it because, you know, 5 years isn't that far away, even though it kind of is. But a lot can happen in 5 years that's beyond your control. You know, when he said keep up with your credit report, well, like if you lose your job and if you can't keep up with it, or if you know your debt exceeds your income, then there are just so many things that can happen that can cause you to fall behind on your credit. So I just didn't have like a good feeling about it. So I went with my gut and we decided not to do the adjustable rate mortgage. Well, thankfully we didn't, because with him telling us that we would definitely be able to refinance and definitely be able to sell, that was not the case. So we decided to go to a big bank, and at that time I didn't know about using a loan officer like who was self-employed. So we went to a big bank. They had a great program that was designed for first-time home buyers. So we decided to go with that bank, and they did give us like a fixed rate. I think it was like around 5% for our first home. So we went ahead and went with that bank. Well, we purchased the home in 2006. 2 years later, approximately in 2008, we actually got caught up in the housing crisis. Like, it was just crazy. So when we bought our first home in 2006 for like I think it was like $175,000 or something, it was actually worth, I think it was worth like 180. We went in with like a few thousand in equity. Well, in 2006, even though our house was worth 180, well, in 2008, once the housing crisis happened, the county sent us the yearly document showing that our house was only worth $120,000 or $130,000. So at that point, let's just say if we owed $170,000, if you owe 170 and if the county is saying your house is only worth 130, that's like $40,000 in negative equity that we had. So of course the county, their estimates sometimes can be kind of low versus if you're actually selling your house, but it's like the housing values around us just went down. So in order for you to be able to refinance your house, that equity has to be there. I don't know of any bank today that would refinance your house if you have negative equity. So with that loan officer that I was telling you about that said, oh, as long as you keep your job and as long as you keep your credit up, you'll be able to refinance. It's not true, because we kept our credit up, we kept our jobs, and we cannot refinance even if we wanted or needed to, because we had like $40,000 in equity. So at one point, we even tried selling the house, but because we owed like maybe, let's say 170, I think the most that we were able to get for our house was like 140. So it's like we couldn't even sell it or we couldn't even refinance it. So I told my husband, I was like, I'm so grateful and thankful that we didn't listen to him. And I don't think, honestly, with the family friend, he was trying to set us up for failure. I don't think he was trying to put us in that position. It's just like the thing that happened in 2008, like people had never experienced that before where like everything just crashed. So I'm just glad and very thankful that I went with my gut, because if we would have went with that adjustable rate mortgage, we wouldn't have been able to afford that higher monthly payment. I think our payment would have gone from like $1,100 to like $1,700 a month. And that's what happened with like a lot of people in 2008. They ended up losing their homes because they could not afford the mortgage payment. So me personally, I would not go with an adjustable rate mortgage. Just to play it safe, I would go with a fixed rate. So renting versus home ownership. I would recommend that if you're in a position to buy, then I would. And the reason why I say that is because we rented apartments for quite a few years, and the amount that we paid in rent was about the same amount that we actually paid for our mortgage. And then also for like every time we renewed our lease for an apartment, the rent would always increase by like $50 or $75. So if you're there for like 3, 4, 5 years, your rent is going to more than likely increase every month. Now, of course, when you have a mortgage payment, your mortgage payment may increase or slightly decrease. It just depends on if taxes go up or if they go down. And with your homeowner's insurance, if you have changes with that, it can go up or go down. It can cause your mortgage payment to, be different from month to month. But overall, your mortgage payment is about the same amount every month. Now, the flip side is with home ownership comes a lot of responsibility. When things break, you don't have a landlord to go to. You're going to be responsible for taking care of these things yourself. But on the other hand, when you rent, when things do break, you are able to report this, and hopefully the, leasing office or your landlord is courteous enough to get it fixed for you. So those are just some things to consider too, because when you purchase a home, you definitely do want to keep it up, because if you ever resell it, then if you have all of these repairs that have to be done, or if you weren't able to do certain things to keep it up, you're gonna have somebody like me who's gonna come in, and I'm going to try to kind of lowball you because I realize that these things need to be done. Now, of course, when I say lowball you, I mean I will be fair, but at the same time, if your roof is leaking, or if you have plumbing issues, these things can be expensive to fix. So, you definitely want to be in a position where you can keep up with your home, not only so that way it's nice for you, but if you ever resell your home, you do want to maximize your profit. So with maintenance. So earlier in the video, when I was talking about that you want to leave some cushion just in case things happen when it comes to you being pre-approved for a certain amount, like we had a home where the hot water heater went out and we had to pay $800 for that. And one time we had to replace a roof on our first home that we purchased, which was a very small house. It was only like 3 bedrooms, 1 bath and a half. So when I called around to different companies shopping, like trying to get like quotes and stuff, some companies gave me an estimate of like $10,000. One company even gave me an estimate of like $20,000. So that house was about 1,100 square feet. So it's a very small house. So I'm thinking like, well, if they're trying to charge this amount for a house that's 1,100 square feet, how much is a roof for like a house that's like 2,000 square feet or, 3,000 square feet? So those are just some things to consider because it can definitely add up when you have to call that plumber if you have something leaking, like if you're not able to repair this yourself, or if you have electrical issues, or if you want to just do things to upgrade your home, like if you want to install like laminate or hardwood flooring, or if you want to change some light fixtures. All of these things definitely cost money. So of course, if you buy a house that's move-in ready, that doesn't need the things that, like if they already have the upgrades that you want, then at that point, I can see how you can kind of go upward as far as with your budget. But if you have some things that you definitely know that you would want to swap out over time, then I would not spend at the top of my budget. Okay, home warranty. I would recommend that if you're in the process of buying a house, you have your realtor to put in the contract that you want the seller to pay for an actual home warranty, because when things break and you're the owner, you're going to be responsible for these things. So I've actually purchased a stove before. It was like $800 on sale, but you could probably find a stove that's a little bit cheaper, but of course it depends on what you like. I've had to purchase a refrigerator before. The refrigerator that I chose, it was like $1,300 on sale. So just when you have to have an electrician to come out, like for example, our electrician actually charges $80 per hour when he comes out. If the job only takes 20 minutes, well, he doesn't prorate it. He charges the entire $80 without plumber. He charges around $70 or $75 an hour. So when you're a homeowner and you have unexpected things to happen, it's like these things can add up. So I have purchased a home warranty in the past, and I had to pay like a small deductible. I think it was like $75 or $100, and they sent someone out to repair the problem. And so you only pay for well, in my case, the one that I chose, I only paid for the deductible. And even if the repair was like $500 or $600, that's something that the company would absorb. So if it was a situation where if they could not repair the actual item, they would replace it with something that was similar to what I had. So the only flip side is a lot of times the warranty may be only for a year. So after that year, you have to decide if you think if it's beneficial for you to continue to pay for the actual warranty. And the only part that sucks is kind of like, if you've been paying for this warranty for like 3 years and you've never had to use it, it's kind of like where you have to make that decision if you think that it's beneficial or cost effective for you to continue to pay for something that you're not using. But a lot of times if we get rid of something, then that's when you need it and you don't have it. So you're like, oh, I wish I would have continued with it. So it's just a decision that you have to make based on your finances to, decide if something happens, can I pay for this out of pocket, like, you know, cash or debit or whatever? Or do you have a credit card that you can put it on? But you definitely don't want to be in a situation where every time something breaks, you're putting it on a credit card, unless you can turn around and pay it off. But yeah, you definitely want to be able to afford the repairs and when things happen. So that is all that I have for this video. If you decide to take the leap of actually purchasing a home, I do wish that you have many, 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 many happy years inside of it. So definitely feel free to subscribe. Be sure to turn on your notifications so that way when I drop any videos, you don't miss out. Definitely feel free to share this video also if you think that it would help anyone, and definitely give me a thumbs up if you thought that it was helpful, and definitely leave a comment if you wish. So with that being said, thanks for watching. Bye.